All right, so let's discuss another situation in which we're talking about the long hedge. So what we had just discussed was the short hedge or selling. Now let's discuss the long hedge or the buying of futures contract. So let's assume that this is Jan again, and this is like the period over which the investor is expecting the changes in price. So suppose that the main plan of the investor is to buy here, okay, buy bonds in June. But the problem is, the problem is the prices in June might be high. Okay, so in order to offset the possibility of loss when the price increase, then the wise decision for the investor is to buy treasury bonds futures now, right? Because if I'm expecting price to go up, then buy now, right? So that you sell it and you make gains. So the idea of buying here is just opposite to the idea of selling in the previous example. So if you go back to the previous example and use the same numbers, okay, then we will be able to get numerical example. So in other words, if the prices, but just flip the numbers. So if the prices now are 94,500 and the prices are going to go up to 98,500, then buy now, sell in the future. Okay, so the idea is to lock the prices at which to buy, right? So buy the treasury bonds future now. Why? Because you basically, as an investor, you want to lock the price at which to buy. All right. So as I said, like if you're planning to buy bonds here and the prices would increase, then buying now would offset the possibility of any loss. Right? Remember, like as an investor, when you have so many securities traded, it's not the idea that you make gains all the time, but sometimes you are accepting some losses, which would be lower than possibility of bigger losses. Let's take an example by the bank. So you know that uh, like banks, they usually or like one of the sources of their funds is get funds from large certificate of deposits, which are basically the long-term savings. So usually certificate of deposits maturity date is 5 years. Okay, so in other words, you are basically using these savings as a source of income. So suppose that these are the balance sheet, this is the balance sheet, this is the assets, this is the liabilities, and suppose that this bank is making loans for 220, and then you have a like total of liability worth of $300, right? Any change in interest rate up or down would affect this one and this one, right? Because this one you're giving out money to people, and this one, like CDs, for example, you're getting money from people. So you would have to pay, right? You basically pay interest on these and get interest from people on loans. The thing is, liabilities are long term. However, the loans mostly are short terms. Even like the majority of the loans would be like shorter than the majority of the of the liabilities. I want you to think about the bank like this. The bank is getting money from CDs, right? And the bank is giving out this money to as loans, or could be like any different type of loan. The bank is getting interest from these loans, but also paying interest on these certificates of deposits. The problem is if interest rate falls, the bank would be adversely affected, right? Why? Because interest rate on assets is more sensitive than interest rate on liabilities. Okay, so the interest rate on these liabilities, the ones that you have to pay, will not fall as the market interest rate is falling. But actually what you're getting from people is more sensitive, so it's going to fall. So you're getting less and you're paying kind of the same, which is a problem. So for the bank, the bank has to hedge on the possibility of a falling in interest rate. If, as I said, the loans are 220 and liabilities are 300, then hedging is expensive because you would have to pay transaction fees and so on. So you, as a bank, managers, they will not hedge on the 220 separately from the 300, but they would hedge on the net exposure. The net exposure is actually the difference between these two numbers, which is going to be like 300 minus 220, it's going to be 80. So the bank would hedge on the 80. How the bank would hedge on the 80? The bank would need to lock the price and interest. How to lock the price and interest? The bank hedge by buying. We're talking about long hedge, right? So buying treasury, bond, futures now to lock the price and interest. So what will happen if the interest rate falls? If the interest rate falls, then the bank would make a gain, right? So the gain that the bank would get, okay, so if interest rate falls, okay, the bank would make a gain that will partially offset any fall in earnings that are caused by low interest rate. Okay, I'm sorry, I'm just writing very small here. Okay, so the idea is if interest rate falls, then this bank would be able to make kind of a partial gain. Okay, all right, so I'm gonna stop here.